Hello. I wanted to kind of pick up our discussion and get into Chapter 3 and Chapter 4. I hope these videos are helping you. I feel like they will. I'm certainly no YouTube expert or video expert, so forgive me for the quality. But the important thing is to try to get through this material and help you understand it. Chapter 3 goes into explaining the primary and secondary markets for financial instruments. Primarily what we deal with as real estate agents, brokers in the business on a daily basis is real estate financing that is conducted through the secondary mortgage market. There are two mortgage markets. The first is primary, and then the second is secondary. The primary mortgage market is where one of your customers might just go down to their local bank, and their local bank might do some type of real estate loan, based on, who the customer is. The underwriting standards are quite a bit different than they are for the secondary market. But typically what we deal with are loans that are sold that are originated with a mortgage lender, mortgage broker, and then they're sold on the secondary mortgage market. Loans that are underwritten using secondary market guidelines means that you can go buy a house in Houston, or you can go buy a house in Washington, D.C. using a conventional loan, and the underwriting requirements are essentially the same for both types of loans. On page 46 and 47 in Chapter 3, there's some good paragraphs in there and some good explanations on why the secondary market holds such an appeal for mortgage companies, for the mortgage industry in general. On page 48, it talks about the real estate cycles, the up cycles, the down cycles, and how having that secondary market tends to provide an availability of mortgage money out there, so customers, buyers can have the availability, or have the ability to borrow money to buy homes. Page 49 goes in to talk a little bit more about the secondary market, and on page 50, at the very top of the page, there is in the box up there, there's a really good some good examples on some of the primary differences between a primary market and the secondary market. Y'all can kind of scan through that. Page 52 and 53, particularly page 53, talks about the secondary market entities. And if you have watched Fox News or CNBC or CNN, you've heard a lot about Fannie Mae. And Fannie Mae is basically an acronym for FNMA, or the Federal National Mortgage Association. Fannie Mae, Ginnie Mae, and Freddie Mac are all government-sponsored enterprises. They're government-owned corporations that are really, really similar structure-wise to like the U.S. Postal Service. And the U.S. Postal Service is a government-sponsored enterprise. Fannie Mae, Freddie Mac are basically insurers of mortgage money. FHA, the Federal Housing Administration, the Veterans Administration are also insurers of mortgage money on the secondary market. And basically, an insuring entity is merely an entity that shields the actual money provider against a financial loss in the event of a foreclosure or in the event of a default by the borrower. So, for example, if you sell a property to John and Mary Smith, 3 years later, both of them loses their job, fall behind on their mortgage payments, they have an FHA loan, and the property goes into foreclosure. Well, say, for example, Bank of America held a loan on the property, but it was an FHA insured loan. In that scenario, Fannie Mae or Bank of America would conduct the foreclosure proceedings on that property, and when that property was foreclosed, FHA is going to pay Bank of America the principal amount due as of the day of the foreclosure, and then Bank of America is going to turn the real estate or the property over to HUD or FHA, which are synonymous, or the same thing. So the Housing and Urban Development is now going to own a property in Abilene, Texas, or Houston, Texas, or wherever the property is located. That is going to be a HUD foreclosure. And, you know, periodically we see those around Abilene. In any market, you will see HUD foreclosures. Similarly, when you see a VA foreclosure, you know that it is a similar type scenario, with VA being the guarantor of the loan or the guarantor of the note. Page 56, 57 talks a little bit about government-sponsored enterprises in the financial crisis, economic crisis, and the buzzword from 2008, 2009 were subprime loans, and subprime loans we'll get into a little bit later in the course, that are mentioned briefly in these chapters, particularly on page 57 and 56. Page 56 talks a little bit about standardized documents and underwriting. As I was saying earlier, with a secondary market loan, or for example, you go into ABC Mortgage here in Abilene, you want to get your customer wants to obtain a 30-year FHA loan. The criteria that buyer has to meet is going to be basically the same, whether that person is buying a home in Abilene using an FHA loan, or they're buying a home in Amarillo or Atlanta, Georgia. The underwriting requirements are essentially the same. So it is a uniform underwriting system. Typically, a lot of it is all automated. So whenever that customer's information is put into the computer or entered into the automated underwriting computer system, that system goes through, checks their credit, looks at their income, looks at their debt, things like that, and issues an opinion as to the credit worthiness of that buyer. Okay? That's pretty much all I want to go through in Chapter 3. You can go and take a look at your chapter quizzes. And then Chapter 4 goes into the mortgage industry itself. It talks about the basic steps in the mortgage process, or for your buyer obtaining a mortgage, on page 70. It goes into the different types of terminology that we as real estate people use on a daily basis in regard to loan origination. It talks about loan officers, retail and direct lending, a loan originator, which would be similar to a loan officer. A lot of this class is learning the definitions or the terminology, and it's not a banking course or a accounting course, but what it does is it makes you understand the lending process enough to ask the right questions, because as a real estate agent, you're going to be in a relationship with your buyer where you're going to be their advocate, and you're going to need to understand enough about the lending process that you can ask the right questions. Page 72 and 73 talks about the differences of loan originators, the differences in what a mortgage broker is, a table-funded loan versus a non-table funded loan, government regulation of the mortgage business and mortgage originators. Page 75 goes in and talks about the different kinds of banks that offer mortgages to your customers. Commercial banks, or banks such as First Financial Bank or First Bank Texas or Bank of America. They're big commercial banks that typically have a mortgage department located inside their branches. So for example, in my office building, I office right next to First Financial Bank. So I can walk 25 feet and take a customer into the mortgage department inside First Financial Bank. The next example are savings and loans, which are somewhat synonymous with commercial banks. Credit unions on page 77 are a little bit different. Credit unions are defined at the top of page 77 in the right sidebar as nonprofit depository institutions typically owned by their members, and their members are their depositors or the account holders in the credit unions. Mortgage companies are basically standalone offices where basically all they do within their organization are mortgages, whereas a commercial bank they're going to be able to offer checking accounts, savings accounts, CDs, different kinds of retail banking type products, where a mortgage company is not going to be able to offer those kind of things to your customers. 78, 79 goes into more government regulation of mortgage lenders. Post 2008, after the Dodd-Frank Act went into effect, the regulations for mortgage companies became a lot stricter. They came under more scrutiny by the government, simply because of unscrupulous lending that occurred prior to 2008. That's what some would argue that was a big cause of the financial crisis of 2008, 2009. On page 81, there's some historical data that you can take a look at. It's real interesting, as talking about Depression-era foreclosures and the creation of the long-term fixed-rate amortized mortgage loans. In the 1930s, early 1940s, there was no standardized 15 or 30-year mortgage. So basically, your customer had to go to their local bank, try to negotiate the best deal they could with their bank, which typically, probably wasn't a fixed rate loan. It probably was a very short term, maybe 2 years, 3 years, and it may or may not have been amortized. Post-Depression era, 1930s, 1940s, 1950s, was the creation of the secondary market. And you can read on page 81, it goes into a lot of detail, giving some of the background on how the implementation of the secondary market took us away from those Depression era days of going down to your local banker, borrowing the money for the house, kind of based on who you were, if they knew you, and so forth. We got away from that, which caused the economy to be a lot more stable. Without a high foreclosure rate, our economy was, it just created a lot more stability there. Page 82, 83 goes into some more historical data on the savings and loan crisis in the 1980s. Y'all can kind of read through that. 85, page 85 gives you the definition of a housing bubble, which we were in for probably 7 or 8 years. Page 89 and 88, 89 go into the Dodd-Frank Act specifically in a lot more detail, and the Dodd-Frank Act not only protects consumers in regard to credit cards, excessive late fees that are charged by credit card companies, excessive over-the-limit fees that are charged by credit card companies, but it also brought a lot of regulation into the mortgage industry in regard to disclosures, what the mortgage company has to disclose to the buyer, to the borrower, when those disclosures have to occur. And when I talk about disclosures, what I'm talking about is, for example, if a mortgage company advertised a 3.5% note rate, they must adhere to that note rate or face penalties that are basically have been implemented by the Dodd-Frank Act of 2008. So those kinds of things is what the Dodd-Frank Act covers, including unscrupulous activities by certain credit card companies and so forth. Page 89 goes into defining what the originator compensation rules are. The ability to repay is a relatively new part of that act, where the mortgage lender basically has to render an opinion in writing on the borrowers of what their feeling is in regard to the borrower's ability to pay. Page 91, 92 is your chapter summary. 96, 97 are the key terms, and then 98, 99 is your chapter quiz. So I just wanted to wrap up those 2 chapters and try to keep us ahead. But as always, in any kind of college course, it's always going to help you to read ahead. Stay a couple of chapters ahead. I'll be posting a test on the first 4 chapters in the next day or so. I'll give you plenty of time to take the test. It will be timed, but I'll give you plenty of time to take it. Thank you.